The institutional markets for financial underwriting, health reserve modeling, and corporate ESG reporting represent a combined addressable market of over $100 billion. Inside these markets, self-insured employers and credit risk modelers are trying to price long-term risk. To do that accurately, they need verified data on human physical behavior every day using consumer fitness apps and smartwatches. But those applications fail institutional audits. They rely on self-reported inputs or GPS tracked by a phone in a pocket. They lack strict Know Your Customer identity binding, and they do not cryptographically prove that a specific human was operating a specific physical asset. Because of these structural flaws, an actuary cannot legally rely on Apple Health data to adjust a corporate healthcare reserve. An underwriter cannot use Strava data to safely adjust a loan yield. The data fails the stringent verification standards required by ASOP, FCRA, and carbon registries. Bridging the verification gap to prove data integrity to a regulator is the primary hurdle to capturing these $100 billion markets. Solving this requires an understanding of the raw physical reality of urban commuting. The system built to bridge this gap was engineered by a former New York City bicycle messenger who understood how analog movement works at street level. The Dandy Horse, or TDH, is the result. It does not sell bicycles. It does not hold hardware inventory. It operates strictly as a business-to-business verification infrastructure layer. The mechanism driving this infrastructure is U.S. Patent number 11,998,801B2. This patent secures a multi-factor verification chain. It defines the exact method of linking a human identity, a physical bicycle, and real-time GPS data into a single immutable digital record. By securing that sequence, TDH converts one analog commuting event into the specific data format required simultaneously by health actuaries, credit underwriters, and Scope 3 carbon auditors. Operating on a pure technology licensing and revenue share model allows the company to capture the enterprise value of these institutional data markets without managing the supply chain of a traditional hardware manufacturer. To understand how physical movement becomes an audit-grade digital asset, we have to look at the 5-layer VIDAT architecture stack. Layer 1 establishes identity. An NFC sticker placed on a physical bicycle is cryptographically linked to a user's verified credit union profile. Layer 2 captures activity. It maps the commuting event using GPS time series data and motion sensor vectors to record the actual physics of the trip. Layer 3 performs validation. It runs multi-factor cross-checks to detect device separation, spoofing attempts, or velocity anomalies that indicate a user is in a car, immediately rejecting invalid inputs. Layer 4 provides inspection. The system applies a SHA-256 cryptographic hash to the verified trip, establishing an immutable, tamper-evident record. Layer 5 routes the output. This single secured record is split and structured for direct API delivery into actuarial feeds, credit bureaus, and carbon registries. Any competitor attempting to replicate this specific data structure faces a severe legal barrier. They must either find a way to circumvent the existing patent or invest years rebuilding a non-infringing alternative from scratch. The VIDAT stack generates the exact evidentiary standard institutional auditors require to legally adjust capital reserves. Cryptographically secure trip data proves an event occurred, but raw GPS coordinates remain useless to a credit underwriter. The data must be translated into an actuarial scoring model to be actionable. That translation relies on established behavioral science. Stanford's delayed gratification studies demonstrated that consistent behavior and strict pattern adherence are highly predictive of long-term human discipline. This graphic breaks down the Behavioral Reliability Score, or BRS. It translates the verified commuting data into a numerical measurement of discipline. The model weighs the frequency of trips, strict adherence to a routine schedule, and the persistence of the behavior over time. To inject this score into legacy financial systems, TDH licenses the data to a distinct entity called Sage Ecotech. Sage Ecotech operates as a credit union service organization, functioning under NCUA Part 712 regulations. This corporate structure provides a strict regulatory firewall. Sage Ecotech translates the verified activity into decision support APIs for underwriting, but it never originates loans and holds zero credit risk on its own balance sheet. Utilizing this SUSO firewall allows TDH to monetize its patented verification data directly inside legacy financial institutions without assuming the heavy regulatory requirements of a bank. This architecture creates an exceptionally efficient unit economic model. A single user acquisition generates compounding revenue across multiple product streams simultaneously. The first two revenue layers come from annual memberships and daily utilization fees. These scale directly alongside the physical deployment of secure bicycle corrals. The third revenue layer scales via business-to-business institutional contracts. Employers pay for the health reserve actuarial data, while credit unions pay yield shares on behaviorally underwritten loans. But deploying physical infrastructure is capital-intensive. A company spending millions on steel corrals typically cannot secure the high valuation multiples awarded to pure software providers. The solution is mapped out in this corporate architecture flowchart. It structurally separates the business into an operating company that holds the intellectual property and a property company structured as a real estate investment trust. The property company absorbs all capital expenditures required to build the physical corrals. That construction is funded entirely by tax-exempt bonds and municipal traffic mitigation capital, keeping the cost completely off the operating company's balance sheet. Once a corral is operational, the property company pays a recurring technology license fee back to the operating company for the right to use the verification network. This corporate finance architecture isolates the hardware depreciation and debt service. It allows the operating company to function on pure licensing and revenue share, perfectly preserving high-margin software economics. The highest execution risk in this business model is time. Actuarial validation requires empirical data, and securing formal acceptance from health actuaries to use that data could face multi-year delays. This chart projects year 3 revenue, contrasting an $85 million base case against a strict $46.5 million floor. That floor holds firm even with zero actuarial adaptation, sustained entirely by platform memberships, corral licensing fees, behavioral loan yield, and card interchange. Under this strict downside scenario, the business still scales past break-even, generates positive EBITDA, and maintains a clean path to a Series B raise. A delay in actuarial adoption limits the short-term valuation ceiling, but it does not threaten the operational floor of the business. The issuance of the first actuarial opinion initiates a compounding network effect. One opinion establishes the data as appropriate for use. That triggers multi-firm proliferation, eventual regulatory normalization, and cements the system as the de facto industry standard for behavioral risk modeling. A well-funded technology competitor cannot quickly overcome this position. Even if they construct a non-infringing verification system, they still lack the longitudinal track record required by auditors. An adversary cannot retroactively simulate years of verified, credible actuarial data. Time itself acts as a structural defense mechanism. TDH operates as an infrastructural arbitrage. It secures a patented verification methodology to capture physical events and translates them to form a multi-market data monopoly.